Hi, everyone. Thank you for joining us today. I'm Marche, the webinar director here at Advice Chaser. Before we introduce our guest and get started, I need to do a bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars, such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting, are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. We're thrilled to bring you today's educational presentation. Attendees are muted, but we do encourage you to go ahead and ask questions and make comments in the chat box, and the presenter will answer those queries during or after the presentation today as appropriate. We will be having a question and answers portion of the webinar at the end of the presentation. If you ask a question in the chat box, go ahead and leave your contact information. If we're not able to get to that question during today's event, we'll make sure someone reaches out to you. Again, we want this experience to be as educational as possible. So please don't hesitate to ask for clarification or expansion of the material. And I just made sure that that feature was turned on. It looks like it's turned on just fine. Well, I'd love to introduce you to our presenter today. Jeff Davis Sr. applies his more than 39 years of experience in the financial services industry to carefully monitoring and reviewing client investments, researching new investment opportunities, and conducting educational seminars and webinars. Jeff has a simple, straightforward approach to investing, utilizing a diversified portfolio of 25 to 30 individual stocks designed to meet his clients' financial objectives. He manages approximately $90 million in client assets. Jeff joined Raymond James in June 2020. Previous positions he has held include Vice President Investments at UBS Financial Services, Vice President Investment Advisor at Wedbush Securities, Vice President Financial Advisor at AG Edwards & Sons, and Assistant Vice President Account Executive at Merrill Lynch. Earlier in his career, he was a loan officer at Guild Mortgage, CalCoast Mortgage, and First Interstate Bank. He earned degrees in business administration from Northern Arizona University and Santa Barbara City College. Well, Jeff, I'm really excited to have you here, and I'm going to go ahead and turn over the time to you. We've got a lot of good information to share today, I know.
All right, well, thank you very much, and I want to thank all of you for joining us today. Today, I'm going to give you 10 tips which can help you to be a better investor. And these tips are based on my almost 40 years of experience helping people with their investments, and frankly, from seeing both their successes and their mistakes over the years. While these tips can help any investor, they're really geared toward investing in the stock market, because frankly, if you really want to build wealth, you're going to need to have at least some of your money in stocks. It's like Willie Sutton said when he was asked why rob banks. He said, because that's where the money is. Well, in investing, stocks are where the money is. In fact, I would say that investing in successful businesses through the stock market is the greatest engine of wealth creation that humankind has ever known. And through the stock market, each of you has the opportunity to successfully build wealth for yourself and for your families. And I believe the following tips can help you do exactly that. So tip number one is to really kind of have an understanding of the stock market. You know, the stock market is really not a mysterious thing, although I think a lot of people who really don't work with it kind of see it as this big nebulous thing that they really don't understand, but you hear on the news, oh, the stock market took a crash today, or things that sound fairly scary, but it really isn't. The stock market is really just a market. It's like the farmer's market. Consists of people buying and selling. In this case, buying and selling shares of companies rather than produce. And as far as the whole thing about the market going up and down, they make it sound like it's either mysterious or it's simple. I mean, I always laugh when these news people come out and tell you why the stock market went up. It's because of this event. Well, no, the stock market goes up for a simple reason. You got more people buying than selling. It goes down for a simple reason. You got more people selling than buying. And if you think you can tell right away in one word why all those people made that decision, you're probably off. Sometimes we know, but more often than not, we don't know why it goes up and down. It's because people make decisions. So, second tip is about earnings. When you become when you buy stock, you're becoming an owner in a company. That's what you're doing. You're buying into a business. And as an owner, as a part owner in that business, what you own is you own earnings. That's what you're buying. The company makes money, we call those earnings. And as a part owner, you own some of those earnings. And basically, you can get those earnings really in one of two ways. The company can either pay a cash dividend, which if they do, they usually do 4 times a year, or they reinvest it back into the company and the company grows. Either way, that's where your earnings come from. But if a company's earnings are growing, it's likely that the value of the stock will grow as well. And so that's really what we're looking for. We're looking for a company who's growing their earnings so that our investment will grow. And number 3 is invest for the long term. The thing about it is, if you're going to if you're investing in a company and you're going to let them make money for you, you have to give them time to do it. What you should not be doing is going in and trying to outguess the market, especially speculating, which I'll touch on in a minute, but trying to trade in and out of the market, figuring out when you should be in and when you should be out. Nobody can successfully time the market. We don't know when the market's going to go up. We don't know when it's going to go down. Anybody who tells you differently is lying to you or they're selling something. But if you do it for the long run and you allow the companies that you own to make you money over time, that is how you become a successful investor. Next slide. Also, if you're going to invest, it's important to buy quality and to make sure that the things you buy have value. Now, what do we mean by quality? We mean buy a company that has somewhat of a proven track record, where you know that you're not buying a fly-by-night company that's not going to be there tomorrow. Because really, you're putting your money there. You want to be sure that it's there when you need that money. And how do we judge quality? Well, there's a couple ways you can do it. You can look at how long the company's been in the business. That'll tell you something. Its history within the particular business. Is it the leader in that particular area? Is it one of the top guys? What is it? You can also look at the strength of their financial condition. You can look at their financial statements, and see if they're financially in a strong position. So that's really the way you judge quality. Value is almost always going to be a measurement of earnings or stock price. So if we find a company that is growing their earnings, that's a value, because that's what we want. We want a company whose earnings grow, so our investment grows. It could also be a company where we see potential for future earnings growth. Perhaps they have a product on the horizon that looks to be very profitable and a very good opportunity. That also is a measurement of value. Or sometimes it's just that the stock, for whatever reason, is trading at a discount to some sort of intrinsic measure of value. Many times, a value company is a kind of a distressed company, one that had something happen, and as a result of that, their stock price dropped, but the markets went overboard and the stock price dropped well below what it might be worth. So sometimes you'll see a company where the stock price is lower than the actual value of the company. So the book value, if you took and broke the company up and sold all of its assets, if you can buy the stock for less than that, that's a clear value. And many times that's the case. Now we get to speculating. The idea is to make money as an investor is to invest, not to speculate. What is speculating? Well, speculating is forming a theory or a conjecture without any firm evidence. It's essentially guessing. And for investment purposes, it means buying into a company for reasons that are not based on research and investment principles, but rather buying into a company based on a guess, which is often based on rumor or hearsay. Now, speculation has a significantly lower probability of success, and therefore carries a significantly higher level of risk. So my advice is don't speculate, invest for the long run, and invest using proven techniques to determine value and quality. Also, don't put short-term money in the stock market, because we're going to look at it a little bit. The stock market can be very volatile and go up and down and up and down. And, you know, it's hard to know because it's the future. It's hard to know what's going to happen next. So if you only have your money for a short period of time, anything less than 5 years, really you're much better off investing that money in short-term investments that are highly safe, like a money market or a money market account, certificates of deposit, excuse me, of deposit, or government notes or bills. Now, one of the things when we talk about volatility in the market is while the markets are volatile, over the long run, the downs in the market have historically been temporary, and the market eventually has rebounded to new highs. I often say that the downs are temporary, the ups are permanent. And if we look at a long-term chart, which we have here, you can see it. Here's a chart that says if you invested $20 in 1897, what would have happened to that $20 over a course of time? And you can see that the value would go up, and then you'd have a drop, and then it'd go up, and you'd have another drop, and would go up and down. And you can see some of them, like here on this particular one. This is the crash in the 20s, which you hear so much about, a huge crash. And yet, if you held steady, eventually you made your money back. Up here, you can see the crashes in 87. You can see the tech crash in 99. You can see the crash in 2007, 2008. You can even see a little blip there at the end, which is a drop that occurred right after COVID came out or began to be a big thing in 2020. But in every case, if you held on, if you own quality, you held on to it, eventually you made money. And so that's why we said before to have a good long-term time horizon rather than putting money in for the short term. Now, one of the interesting things is that as an investor in the stock market, your emotions are your enemy. Because the truth is that when the markets get hot, greed will kind of kick in, and we all want to be part of it. And we'll go in and we'll buy things, and we'll buy them at a high level, or we'll concentrate our investments. And then when the opposite happens, when the market goes down, you'll be worried about losing your money, and fear will cause you to want to sell low or even pull back from investing altogether. Where the truth is, if you want to make money in the market, that's just the opposite of what you should do. You should buy low and sell high if you're going to trade. This is what happens all the time. It's your emotions. It's one of the things that you really need to guard against. It's one of the reasons, frankly, why working with an advisor can be invaluable, because they can help you not to do that. But keep that in mind as an investor. Don't invest based on your emotions. Also, if you're going to invest specifically, I mean, you can invest in the stock market in a lot of different ways. You can buy ETFs, you can buy mutual funds. There's a lot of things you can do. But whatever you do, you should have a strategy. And most specifically, if you buy individual stocks, you should have a strategy to do so. You shouldn't just do it based on a guess or shooting from the hip. You should have something that tells you exactly what to do. Because your strategy is going to let you know exactly what you own and why you own it. And it's also going to help you to make decisions about when to buy, or more importantly, when you should sell, when you should get out of something. And one example of that, there's lots of strategies out there. One, which is actually the one that we use when we buy individual stocks, it's called a rising dividend strategy. And that's a strategy, it's a very simple thing. It says that all the companies that we own in this portfolio have to pay a dividend regularly, and they have to increase that dividend, hopefully once a year, but at least increase it with regularity. And the reason we do that is because, frankly, those tend to be leaders in their groups. There aren't that many companies out there that do that. You tend to own the better companies if they're able to not only pay a cash dividend, but they're able to increase that dividend every year. And they also tend to be the less volatile. So like we just had in 22, the market overall dropped about 18%. Our rising dividend stocks dropped anywhere between 7 and 9%. So they were much less volatile than the market as a whole. But the good thing about it is it tells us what we own and why. We own companies that pay a dividend and increase them every year. Why do we do that? We do that because they're great companies and they tend to be more defensive than the market overall. When will we decide to buy or sell? Well, the buy decision is really when we have the money to do it, but the sell decision goes back to that dividend. As long as our companies are paying a dividend and increasing it, we're unlikely to sell it. If we see something where it looks like there's going to be a problem, like the company may have to stop increasing the dividend, may have to cut the dividend, then we tend to sell it. Like Disney, as an example, in summer of 2020, cut their dividend. So we sold out of Disney. We stopped. We don't buy Disney anymore. If they start paying a dividend again, we might consider it. But it's a good way to guide you and help you have confidence in what you're doing and stay away from the greed and the fear to do it based on a specific strategy.
That's an interesting take on that. What other kind of investment strategies are out there?
There's another one that I've heard about for years. I've actually never used it. It's called the dogs of the Dow. And what it does is every year it takes the 10 highest yielding Dow stocks, which tend to be the ones that are priced the lowest, and buys those. And then at the end of the year, it looks at the Dow, which is 30 stocks, looks at those 30 stocks again, and makes sure that, again, it owns the ones that have the highest dividend and the lowest price. And so it's just an ongoing yearly rebalance that people use. I've heard it's done well. I've never used it myself. But there are other ones. If you're buying mutual funds, as an example, one strategy people use is to divide their money in mutual funds between growth managers, value managers, international managers, and small company managers. And they create a weighting so that maybe you have 30% in growth, 30% in value, 20% in international, 10% in our small company. So there are many different strategies that one can use. But the point is, I think that once you determine on one, make sure it's time tested, make sure you can track it back and see how it's worked, and then stick with it.
Very interesting. Thanks for that clarification there.
So our last tip for today is to find an experienced advisor to help you. Now that may be somewhat self-serving. Yes, it is, but it's also true. Because the truth of the matter is that an advisor, for whatever it is you have to pay that advisor to work for you, the thing, if that advisor is a good advisor and really does what he or she needs to, you should earn that. You should make more than that from their advice. If you don't, get a different advisor. But they can really help you do three things that should help you achieve your long-term goals. First of all, help you to set up a diversified quality portfolio. And again, whether you're using stocks or mutual funds or EFTs or a combination of stocks and bonds, an advisor should be able to help you to set up a quality, diversified portfolio. Secondly, to help you make appropriate changes to your portfolio when they're needed. You know, that I often say that a portfolio is like a bar of soap. The more you put your hands on it, the smaller it gets. So you don't want to be just trading things, selling things just to do it because it seems like a good idea. You want to do it for a solid reason where it really makes sense. And an advisor can help you to do that successfully. And then lastly, as an advisor can help you to stay the course. So, you know, if you have a strategy, you think, oh, gee, market's so hot, I want to get more involved in technology like my client did, help you to not do that, to stick with what you're doing. Or when the markets are going down, you feel like, gee, I need to get my money out, help you to stay calm and say, no, you own quality companies. They've been around for decades. They're going to still be around decades from now. Stay invested, let the company do the work for you. So really a good advisor should help you do those three things. And if you do it properly, should help you to reach your goals and make a good return.
All right, we're going to open the floor up for some questions now. What's the difference between like a dividend stock and a growth stock? And why might you want to invest in, as you said, dividend stocks that are your favorites here?
Look, if you think about earnings for a second, which we talked about earlier, which is what you own when you're a shareholder, those earnings can come to you in one of two ways, as I said, either cash or growth in the stock. But if you think of it from the perspective of the company has a choice in what to do with those earnings. You know, they can decide to pay them out to the client, to the shareholders, or they can reinvest them back in the company to create more growth. Now, we like companies that do both, that pay out dividends and have money to reinvest. But I would say that the reasons to do one versus the other is really just going to depend on what kind of strategy you want to set up. Because some strategies will focus more on the growth type stock and some less. But the bottom line is, it's really just, from my perspective, a choice of whether you want to get some of your return in cash, whether you want to get regular payments, which can be reinvested so you can compound it, or whether you just want to let the company reinvest all the money back themselves. Does that answer it?
Yeah, thank you so much. And we did have a request from one of our viewers to ask if we could just review really quick the 10 tips again. So I'll just go through the slides one more time, and maybe you can just read off the tip.
Sure, absolutely. So first one, understand what the stock market is. It's not mysterious. And second one, it's all about earnings. As a shareholder, that's what you own. Third one is invest for the long term. Fourth one is buy quality companies that also have value. Fifth one is to invest rather than speculate. Sixth one is don't put short-term money in the stock market. And then the seventh is that long-term growth outpaces downturns, or as I like to say it, the downs are temporary, the ups are permanent. As an investor, your own emotions can be your worst enemy. And then to use a specific strategy for investing in the stock market. And then lastly, find an experienced, and I emphasize that word experienced, advisor to help you.
Thanks for that review there. Can you talk about what your take is on alternatives? So I want to ask a question about that.
On alternative investments?
Yeah, so real estate and private equity and things like that.
Yeah, well, real estate's in a completely different boat. We all should have real estate in our investments. If you're a homeowner, you do. If you're a homeowner in Southern California, you have way too much of it already. But things like private equity, there are all kinds of alternative type investments. The thing that there's nothing wrong with them, except the thing you have to do is you have to really be able to identify the risk that you're taking to be in those types of alternative investments. I tend to stay away from them because I think that you really don't need to do those things. You can make great money just being a stock investor, and I often find that it's that the more complicated they are, the harder it is to understand the risk that's involved in them. You talk about private equity. Private equity just would tend to make you not as diversified as being in public equity. There's generally not as much information available for a private equity placement. Doesn't mean there's anything wrong with it, but for someone like me who is investing client money as well as my own, I have a higher duty to be sure that what I'm doing with that money is going to work out and it's not going to be lost to my clients. So I tend to stay away from newer things, from complicated things. There's a lot of these, they call them structured notes that are out there where you can buy it and you get this participation in the market with this now amount of downside risk. And I just think the more complicated you make it, the harder it is to really have a lot of faith in what you're doing. So I'm not a big fan of alternative investments, but that doesn't mean that there aren't some good ones. It doesn't mean that some of them don't work. It just means I'd rather keep things simple.
What's your take on investing a little every month versus making a big investment every year or every quarter?
Well, I think if you have the money in a lump sum investment, I wouldn't take it. If I had a sum of money I wanted to invest, I wouldn't dribble it into the market over time. There are people who say do that, dollar cost averaging. I'm sorry. I think if you're going to be in the market, put your money in, let it start working for you, start building dividends you can reinvest. If you're talking about that you're doing it on your paycheck or you're doing it something like that, yeah, just put it in monthly. There's no reason to save it and put a lump sum in later. Put it in as you have it. If you've got a good strategy, just keep buying into the strategy and do it over time. There's nothing wrong with that at all. That's a great way to invest.
All right. Well, that's about all the time we have for questions today. I want to thank everyone for your thoughts. And we want to thank Jeff for being here and the organizations that have made this webinar possible today. To our attendees, look for a link to the replay of this event. And you're welcome to share that replay with friends and family. And we will also be posting it on our website as well. Here at Advice Chaser, we're all about helping you find a financial advisor who's a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners has committed to offer a free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. Well, once again from Advice Chaser, thank you everyone for coming, and we will see you at another webinar soon. Goodbye, everyone.